Welcome to the deep dive. Today we're doing something a bit different. We're cutting straight to the chase, focusing only on the Q&A from BlackRock's Q3 2025 earnings call.
Exactly. No prepared remarks, just the questions from analysts.
Yeah.
That's often where you find the real strategic thinking, the answers to the market's anxieties.
Yeah, it strips away the polish.
Right. So our mission today is to really synthesize what came out of those discussions. We're talking about their big M&A moves, HPS, GIP, the whole push into digital assets, tokenization especially, and how they see major shifts like private credit and retirement evolving.
And the big takeaway, reading between the lines of those answers, seems pretty clear. They're validating the strategy of really diversified, but also high-margin growth.
Absolutely. They're buying companies, they're building new tech infrastructure, they're even trying to shape regulation. It's all about grabbing hold of these big structural changes happening in the markets.
It's a fascinating look at what it takes to stay dominant. Okay, let's start where Craig Siedenthaler did that incredible organic growth figure, 10% organic base fee growth in Q3. It's double their long-term target of 5% plus.
It is staggering. And the key theme in their answer was diversification. But, it's not just any diversification.
Right, it's the quality of it.
Exactly. This isn't just index funds riding a bull market, although iShares is obviously still core. The real acceleration, the stuff pushing that number up, is coming from more specialized, higher value things.
Like what specifically?
Well, they mentioned digital assets, their systematic strategies, active ETFs are huge, and also big outsourcing mandates they're winning. They literally said growth across every corner of a client's portfolio.
Okay, let's pause on active ETFs because they gave some really concrete examples there, didn't they? Showing it's not just talk.
They did. Two big ones. DYNF, that's run by their systematic team, a fixed income fund. It's now a $30 billion franchise.
30 billion. Wow.
Yeah. And then BAIN, which is their flexible income fund. That one's hit $13 billion. These aren't small niche products anymore.
No, clearly not.
And these examples, they highlight this pivot to more active, specialized stuff. Which brings us to maybe the most important number dropped in the whole Q&A.
Which was?
The fee yield. The fees they're earning on the new money coming in. It's 6 to 7 times higher than the yield on flows back in 2023.
Wait, say that again, 6 to 7 times higher.
6 to 7 times.
Yes, that's not just growth. That's a massive shift in profitability for new business.
Precisely. If they were just gathering cheap passive assets, that yield would be flat, maybe even down because of fee pressure. This massive increase basically proves their strategy is focusing on these more complex, higher fee things like active bonds, private credit, digital.
Yeah.
It changes the whole economic profile of their growth.
Okay, that focus on high-margin, future-focused areas, it feels like a natural lead-in to tokenization, which Michael Cypress asked about. They sounded pretty excited about that one.
Oh, absolutely. They called it one of the most exciting potential markets. And the ambition here, you have to understand, it's not just about launching a tokenized fund.
It's bigger than that.
Much bigger.
Yeah.
It's about building new infrastructure. The goal is the totally seamless integration of traditional assets, your stocks, your bonds, ETFs, directly into digital wallets.
So you wouldn't have to cash out of your digital wallet and then go buy an ETF somewhere else.
Exactly. The vision is you never leave that digital environment. You can allocate straight from your crypto holdings or stable coins into a long-term investment product, all within the same wallet.
And they see a demographic angle there too, right? Connecting with younger investors.
Yes, that's a huge part of it. Younger generations are already comfortable, native users of digital wallets and tokens. So the thinking is tokenization meets them where they are. It could get them into traditional long-term saving much earlier in life than previous generations.
Yeah. That could be massive for closing the retirement gap eventually. But what's the advantage now? Operationally. I mean, the current system works, right? It's just a bit clunky.
Clunky is an understatement sometimes.
Yeah.
The real unlock is efficiency. Think instant clearing and settlement. Right now, public markets are moving to T+1, settling in one day. Private markets, forget about it. It's PDFs, emails, weeks of back and forth sometimes.
Yeah.
Tokenization allows for instant atomic settlement. One transaction, done. It cuts out layers of intermediaries, reduces costs, eliminates errors.
Yeah.
It's not just faster, it's fundamentally better plumbing for the financial system.
And that better plumbing, that instantaneous settlement, that's what enables the vision Brian Bedell asked about these new kinds of model portfolios.
Precisely. If settlement is instant, you can start mixing things that were just too operationally difficult before. Imagine scaled model portfolios that natively blend tokenized traditional assets, maybe some crypto exposure, private assets eventually, all settling immediately.
That's a world away from trying to manage models with T+1 stocks and, monthly NAVs for private funds.
Exactly. It allows for complexity and scale that just isn't feasible today. That's the real operational advantage they're building towards.
Okay, so moving from the digital cutting edge back to something more traditional, but still evolving private credit. Alex Blast brought up the anxiety in the market. Headlines about defaults. What did the HGITS team, their new private credit folks, say they're seeing?
Yeah, that was a key question.
Hmm.
And the message from BlackRock, well, from the management relaying the HPS view, is pretty reassuring, actually.
Oh, yeah.
They said their teams are seeing generally strong credit quality within their own direct lending books. They made a point of differentiating. Those big bankruptcies making news, mostly in the broadly syndicated loan market, the CLO market. They emphasize not typically in the large controlled direct lending deals done by managers like HPS.
Ah, so it's about control again. The argument being that direct lenders like HPS have much tighter loan agreements, better access to management, more levers to pull compared to just holding a piece of a widely syndicated loan.
That's exactly the argument. Better underwriting, more control. It's a quality differentiation play. And this ties into the whole integration strategy, which Brennan Homan asked about. How are they actually merging these big acquisitions, GIP for infrastructure and HPS for credit, into the mothership?
Right, and wasn't there a surprising comment about how difficult, or rather not difficult, it's been?
Yeah, that was interesting. They claim these integrations, GIP and HPS, were actually less difficult than some historical ones, like BGI, the huge passive manager they bought years ago, or Merrill Lynch investment managers.
How can integrating complex private market firms be easier than integrating index funds? That seems counterintuitive.
Well, their explanation suggests their M&A muscle has really developed. The philosophy now is one BlackRock, not a collection of boutiques, full integration. But why easier? I think the thinking is BGI was a scale acquisition, merging two giant, somewhat different cultures. HPS and GIP are more about plugging specialized expertise onto the existing BlackRock platform.
So it's like bolting on specific capabilities?
Kind of.
Yeah.
These teams primarily need distribution, funding, and technology things BlackRock has in spades. So you integrate them onto Aladdin, the central tech platform, and then unleash the global distribution network. It's more of a platform integration than a fundamental culture clash, perhaps.
Okay, that makes more sense. Let's zoom in on HPS then, which Dan Sanan asked about. Where are those synergies actually showing up? Where's the growth coming from now that they're part of BlackRock?
Two huge areas they highlighted. First, insurance. BlackRock is already the world's biggest manager for insurance general accounts, over $700 billion. Now with HPS, they can build these sophisticated portfolios blending public bonds and private credit, tailored specifically for those big insurance clients.
Right, bespoke solutions, leveraging both sides. And the second area?
Wealth management. This is where they see enormous potential. They're pushing hard on semi-liquid products, things like BDCs, multi-asset credit funds, interval funds, basically ways for wealthier individuals and their advisors to get exposure to private credit.
So bringing private markets downstream.
Exactly. And the target is ambitious. They have about $30 billion in retail alternatives now. They want to more than double that, hit $60 billion plus by 2030, really leveraging HPS's connections in the private bank and RIA channels.
And HPS is already contributing significantly, right? There were some fee numbers mentioned.
Yeah, just as a quick aside, Ben Du's question clarified that. In Q3 alone, HPS brought in $225 million in base fees and another $270 million of performance fees.
Yep.
So it's already a major contributor. They expect performance fees might be a bit lower in Q4 seasonally, but the underlying private credit flows are expected to be pretty steady.
Okay, big numbers. Let's shift gears again back to the public markets, but looking at the wrapper itself, the ETF. Ken Worthington asked about this idea of creating ETF share classes for existing mutual funds.
Ah, yes, the ETF share class structure. This is a potentially massive plumbing change for the industry. BlackRock is very positive about it.
Why is it such a big deal?
Well, it helps investors and advisors who are shifting from the old commission-based brokerage model to fee-based advice. If this gets approved and implemented, you could potentially convert a mutual fund holding into an ETF share class of the same fund.
Without selling and triggering taxes.
Potentially, yes. It allows BlackRock and others to leverage their huge existing mutual fund assets and long track records within the more modern, often preferred ETF structure. It makes that transition much smoother.
But it's not just flicking a switch, is it?
Oh, definitely not. They were clear about that. Making this work across the entire ecosystem, custodians, transfer agents, platforms, it's a huge operational and technical lift. It'll take time to fully operationalize, even if the regulatory path clears. But the potential is enormous.
That theme of structural change leads us nicely to the final big topic, which Bill Katz raised: retirement. Specifically, getting private market strategies, like the ones HPS offers, into 401k plans.
Right. Defined contribution plans. This is seen as a massive, largely untapped market for alternative. And BlackRock sees real momentum building. They pointed to things like recent executive orders, draft safe harbor rules from regulators.
Yeah.
The plumbing is slowly being put in place.
And BlackRock feels uniquely positioned here.
They do, for two main reasons. First, they have decades, literally 30-plus years, of experience designing glide paths for target date funds. That's the intellectual property around how you manage risk and liquidity for someone saving over their entire working life. They argue that expertise is crucial if you're going to safely incorporate less liquid, more complex private assets. It's not just sticking a fixed percentage in.
Okay, the investment expertise. What's the second reason?
Technology and data. This brings in Aladdin and also their acquisition of Preqin data. If plan sponsors, the employers offering the 401ks, are going to add private markets, they have a fiduciary duty. They need really good data and analytics to justify it, to benchmark performance, to manage risk.
So the tech platform becomes essential for compliance and due diligence.
Exactly. It's the infrastructure needed to support the regulatory shift and give fiduciaries comfort. Could be a huge unlock for their integrated tech offering.
And it all loops back, doesn't it? Larry Fink apparently closed the Q&A by hitting that demographic point again, connecting younger people's money, the cash sitting in those digital wallets, to retirement savings much, much sooner.
Yes, that linkage was clear. Use tokenization to bring them in early, use sophisticated strategies including privates to boost returns, use the glide path expertise to manage risk, and use the tech platform to make it all work. It connects the digital frontier right back to the core mission of long-term retirement security.
So, putting it all together, what this Q&A really showed is a company firing on all cylinders, wouldn't you say?
I think so. You've got these massive acquisitions, HPS and GIP, being integrated. At the same time, they're genuinely trying to pioneer new financial infrastructure with tokenization and simultaneously leading potential regulatory changes in a market as huge as retirement. It's incredibly ambitious.
And the differentiation they seem to be pushing is this ability to offer the whole portfolio: public, private, liquid, digital, all integrated, all underpinned by Aladdin, not just a collection of separate shops.
That's the one BlackRock message, exactly. Comprehensive solutions, unified tech, integrated expertise. That seems to be the core strategy revealed through these analyst questions.
Okay, so let's leave our listeners with a final thought, building on all this. Given BlackRock's sheer scale and this really aggressive push into tokenizing everything, including long-term investments, how fast could things change?
That's the big question, isn't it? How quickly does the traditional financial hierarchy get disrupted when assets can just flow seamlessly between, say, a public ETF structure and a digital native tokenized format?
When does a tokenized share class become the default, not the exception?
Exactly. What's the timeline for mass adoption of this new infrastructure they're building? Definitely something to watch closely as all this unfolds.